99% of businesses start with friends and family money. In 2008, if any of you are old enough, there was a financial crisis, a huge, one of the largest financial crises. And I was in real estate, and I didn't have money. I lost a lot, and I didn't have money. And I called a bank I worked with, a lender that I work with, and I asked the CEO of the bank to talk to me. He knew me very well. It was a lender. It wasn't a regular bank. And I said to him, look, I want to tell you up front, this month, that was the end of the month, so I could have had plenty of time. This month, I'm not going to pay you the interest. And he was like, what do you mean? He said, look, today we're doing something a little different called Unmask Academy or University. So I get a lot of questions around investors. When you hear the word investors, you might have a reaction saying, hey, I don't want investors. I'm not dealing with it. So I'm going to walk you through the different levels of people involved in your business, whether you are someone who already run a business and has a situation when you hit a glass ceiling or a ceiling you cannot grow further, or you have an idea, you have a brilliant idea, you maybe work as a sous chef or a cook in a restaurant, you want to open your own restaurant, coffee shop, all the way to startups, technology, etc. So we're going to walk through the 4 different levels. We're going to spend a few minutes on each one of levels. I'll give you the tips, the benefits, the challenges of each level, and how you can keep on growing your business, okay? So that's what we're going to do today. Welcome to Unmask Academy. So investors, when I say investors, a lot of people say, I don't have investors, I don't have people involved. Now, you might have a business or you have a plan to start a business just by yourself. And you're very, very lucky because most people don't have the money it takes to build a business by themselves. You might have a rich dad or a rich uncle who wants to support you. By the way, that rich uncle or that rich dad is an investor of yours. So how do we want you to think about investors? I want you to think about investors as outside money. Now, let's just pause for a second and just differentiate for 1 minute. What do I mean outside money? In every business, walk down the street, wherever you live, you'll see in every business that generally, again, there's always exception to the rule, but there's 3 components in every business. You, what's called sweat equity, someone who actually works in the business ongoing and is running it. The next thing is investors, money from the outside. It can be someone you gave you money, can be your friends, your family, or all the way to large insurance companies that are investing with you. Maybe, but we'll talk about it in a minute. And the third one is debt. Many, many businesses have debt. What do I mean by that? You go to a bank, you're asking for a small loan, a small business loan from a bank, that's debt. We're not going to talk about debt today. We're going to talk about equity. Equity means people who are running the wave with you. I'll explain more in a minute. Okay, so let's start. Again, think about it. Every business you see have investors. Okay, so let's talk about investors. You just had an idea. You are very excited. I'm going to make it very, very simple. You are working as a sous chef and you've been working for someone for a while and you're very happy, but you know you want to own your own restaurant. But to open a restaurant, you need $1 million. Or in New York, you need $15 million. You don't have $15 million. Maybe you saved, maybe you have some, but there's no way a typical person who went to cooking school has $15 million or $1 million. So what do? You go to the first circle of investors. It's called friends and family. What's friends and family? It's exactly what you just said. It's friends and family. So you finish school, maybe you finish grad school or undergrad or even high school, and you say, I want to build a business. And you need $1 million and you only save $100,000. What do? You go and talk to as many people as possible. That's generally, I'm generalizing today, but it's very important to say 99% of businesses start with friends and family money. They're your friends. They went to school with you. Maybe some of them have more money than you. Maybe they come from wealthier families. And you say to your best friend, hey, John, look, I have this vision. I want to open this business. I want to open this restaurant. How do I start with that? And sometimes it's just luck. You meet someone who went to school with. And by the way, that's one of the reasons people go to really good schools, because the network of connections you have there is bring you more exposure to more money because wealthy families send their kids to best schools. But again, put it aside, you go to friends and family. You maybe have an uncle or a father or a brother-in-law that has money, and you sit in front of them and you present to them a very simple business plan. I have this vision. I've been working. I have experience. I'm a great cook. Again, I'm taking the example of cooking, and I want to open a restaurant. And here on friends and family level, the pitch is very simple. Here's my vision. Here's the basic numbers. You don't have to do a whole crazy business plan. Yes, you can show them more, but they're not going to really dive into it because what they invest in, the investors focus on one thing, or I would say maybe two things. One is you. They invest in you. They need to know you personally. You rarely meet someone who invests on the very basic level, what's called pre-revenue in technology. When you have a startup, it's called pre-revenue. You rarely have someone investing in you without knowing you personally. They want to know you. Now, why it's called friends and family? Because they know you. They grew up with you. They know you for a few years. So you don't have to prove to them that you're honest, that you're hardworking, that you have a great idea. So one part of it, 80% of their investment will come from the fact that they want to support you. Maybe because they love you, maybe because they feel for you, or maybe because you think you're hardworking and brilliant. All of the above is okay. The other part of friends and family is the business. So if I come to you and say, look, I want to start a restaurant, and you know me and you know I'm a great cook and I'm wonderful and et cetera, I'm hardworking, but I want to start something that I personally, the investor, doesn't believe in, that's the other part of it. So if someone wants to open a fried chicken place, and I know nothing about fried chicken, and I have this wrong concept, they say, yes, we love you, we trust you, but the concept is wrong. So therefore, you have to play only on two levels. One is you, they invest in you personally, and the other one is the business idea. And that's the easiest, simple way to raise money. Now, why do you not continue and just stay with friends and family? Because friends and family is limited. It's very flexible. People understand that they trust you, they want to support you, they want to help you, but it's limited. So you open a restaurant and it's going very well. You're actually doing very well, and you raised $1 million from your investors, and you have a relation with them. By the way, in legal terms, there's two hats in a company. One is called GP, and the other one is called LP. GP stands for General Partners. That's you. That's a person who's actually running the business day to day, takes a salary, takes higher percentage of the profits, and is actually waking up every day and working in that business. And there's LP. LP is limited partners. Those are the investors. So people give you money and say, look, you run the business, you pay all the expenses, and when you have money left, I want you to get my money back. So I give you $1 million, or I give you 10 people, give you $100,000 each, and now you have profits. You give us the money back, and we split the profits, whatever it is, 90%, 20%, 50%. It depends on the business. By the way, there's a lot of standards. You can actually search and ask around the very standard things of how you split the money with investors. So you don't have to reinvent the wheel. Traditionally, you first of all bring the money back. So I gave you $1 million, or a group of us gave you, our friends gave you $1 million. You don't take any profits home, maybe a little salary, but that's it until you give me my money back, my $1 million. And then after that, we split the profit 70% to the investors, 30% to you, or up to 50-50 in that perspective. So that is friends and family. Now, again, let's talk about the benefit of it. The benefit, people invest in you. You don't have to worry too much about structure, profits. It's inexpensive. You have to pitch it to them, but they trust you. You don't have to spend tons of money on attorneys. You just have a basic agreement with those investors. The challenge with this, it's limited because it can really go more than $1 million, $2 million. It's pretty much impossible to raise money from friends and family for a large scale. Not only that, let's just say I'm your best friend and I trust you, I made some money, I'm an attorney, I'm a doctor, I saved some money, and I give you $100,000. And you're growing and doing great. it will be impossible for me to invest with you for your next venture, for your next growth before I got the money back, because I'm just limited. I gave you $100,000. I can't unlimited give you money. So if you do a real estate transaction, you're buying a first building and it's going very, very well. In 6 months later, you want to buy another building, I'm going to say to you, hey, this is wonderful, but I don't have the money to give you more. So that's the limit. So friends and family, that's the first circle. Kind of like imagine yourself in a circle. That's the core thing, the beginning, starting phase, friends and family. Let's go to the next one, okay? So you open a restaurant and it's going well and you're happy and your investors are seeing money and everybody's going well, but you're thinking about larger scale. You want to grow from one location to 2 locations or 3 locations. You maxed out friends and family. You no longer can tap into that. Now, friends and family are important because they're going to introduce you to the next level of investors, and that's critical. I'm going to keep on repeating it. It's critical and important to take care of your investors, whether it's friends and family all the way to public money, which we'll talk about in the end of the conversation. It's important to take care of investors because they are your biggest ambassadors. If you do well with investors, they would love to invest with you. When I did the first round of raising money many, many years ago when I just started, I returned some profits to my investors. I didn't have to return all the money, but some profits. And the people who invested with me went to their friends and they say, oh yeah, I just made money with this young guy who I invested in real estate in Brooklyn. And those friends became curious and interested in investing with me. Now, it wasn't anymore my friends and family. It was friends of friends. Again, think about it. You take care of your first circle, they will take care of you because they're going to spread naturally. People like to share, show off, invite other people. Now, you can create incentives. It's natural for people to talk about their success. So if your friend did well and now they're sitting on vacation by the pool and say, yeah, this vacation is paid by an investment I've done with this person, then people go like, oh, I'm curious. I want to invest also. If let's say it's a doctor or an attorney or someone who is doing well but wants to look for more opportunities to invest with, they're going to come to you. But another way to increase the circle is by saying to your investors, your friends and family, your first immediate circle, the original circle, you go back and you say to them, look, I'm actually going to the next level. I'm opening my second branch. I'm opening my second location. I'm building another building that I'm in real estate. Help me. Help me because I took care of you. Help me because you know I work very hard for my investors. But also maybe help me because I'm going to incentivize you. For every investor you bring me, I will pay you for that. And that's a very standard things to do. It's called equity brokers. It's actually very common. Now, there's people who do that for a living, equity brokers. They bring you investors and you pay them. But your friends, your family, your people that you connect and know, your employees. I raised a lot of money from an employee that worked for me, and they loved what they saw. They saw how hard they were. And they went to their rich uncle or aunt and they say, hey, I'm working this company. They're raising more investors. And the uncle who lived in Miami Beach said, next time in New York, I want to come and meet with this person because I'm looking for more opportunities. So we incentivize them by paying them. So from your core original circle of friends and family, now you go to the next level, which is called private money, wealthy individuals. Each one of you, look, you might be very poor. You might be coming from a background with no wealth in it. And I came from a family that has no financial connection when I started. It took me time. It's easier when you have connection, when you went to really expensive private schools, and therefore the network is better and bigger. But it doesn't matter. If you start with the first location with friends and family and you did well, you took care of them, they will share with you the next level. And they're going to open the door for you for the next thing. And the next thing is wealthy individuals and private money. So how do you do that? You are now not talking to people who already know you. You're talking to people who know you through someone else. So therefore, the benefit of it, they can write you a bigger check. Now you have, let's say, original investors. You had 10 investors with $100,000. Now you have maybe 10 investors with $250,000 each one of them. Now you raise $2.5 million with 10 investors because those people are wealthy. They have an ability to take a portion of their portfolio and say, I'm putting on this new venture. I'm putting this money on this new restaurant, on this new startup, this new app that this person is developing. Now you just increased the amount of money you raised. The challenge is you need to earn their trust. And the more disconnected they are from past experiencing, what do you mean? I mean by that, the more, look, again, going back to friends and family, they know you for many years. They know you're honest. They know you're hardworking. The friends of friends or people who found out about you, okay, they don't know you. The less I know you, the more I'm going to be busy with building protection. What do I mean by that? With friends and family, maybe a shake of a hand or a very basic document will set up the relationship. I get money from you, I work very hard, I get your money back, and then we split the money, the profits 50-50. I'm just saying an example, right? Now, I was introduced to someone who doesn't know me personally. They're going to ask for more protection. What does that mean? Legally. The more distance you are from your investors, probably the more complex and expensive the legal document will be because they don't know you. What if you take the money and run away with it? And they will be more suspicious. So in the beginning, with friends and family, you can be very flexible. You can say, hey, I'm planning on paying in the next quarter profits, and then something happens, and then you call them and say, hey, John, I'm really sorry. I'm going to postpone the payments for the quarter after. John maybe is not happy about it, but he's your friend. He knows you, understands that he took a risk when he invested with you, right? But if John's uncle or someone he introduced him through work, you call them and you say, I don't have money to pay you this quarter, it's going to be better. They are more suspicious because they don't have the past. They don't have the relationship that John has with you. Therefore, you need to tie it up. You have to anchor it in a legal document, right? So therefore, they're going to ask for more. For giving you an example of difference, many investors, and we spoke about earlier, LP, limited partners, if they don't know you personally, they're going to say, look, I'm going to give you money, but I want to have protections. For example, I want an accountant to come once a quarter to your office and check the books. I want to make sure you don't buy a Ferrari with my money, right? Now, you might be annoyed. Understand that it's the challenge and the opportunity when you increase your circles. In every conversation, in every circle we talk about, there's benefits and there's challenges. There's good and there's bad. Again, friends and family, great, it's easy. Talk to 10 of your friends. 2 of them going to invest. Good for you, very little work, really fast money, small amounts. Increase the circles, more protection, more legal cost, less freedom for you to do whatever you want. So this investor might come back to you, that wealthy individual, which, by the way, the reason they're wealthy, most of them, is because they have a lot of experience. So they can help you. That's the good thing about it. They can connect you to other people. They can give you advice. They can sit on a board with you, which I'll talk about. But they might send you and say, look, you can write a check to whatever you want. I want to make sure that when you invest, it's in your restaurant, in the business I invested in. I don't want you to open a hot dog stand next to it as part of the venture because I never invested in a hot dog stand. I want to invest in that specific restaurant. And I'm going to bring an attorney or an accountant every quarter to check that you've done with my money what you promised you're going to do. That's one thing. The other thing, many investors will put caveat in the agreement and say, look, I have the right to take over the business if you misbehave. Not if you are not doing well. That's never agreed to that, right? But for example, if you embezzled, if you lied, if you cheated, if you mismanaged the money, I have the right to kick you out. Now, again, going back to friends and family, John, he trusts you. You might lose your friendship if he's not a great guy because you mismanaged the money. But in the end of the day, John doesn't care that much. His wealthy uncle or the person he introduced you to is suspicious. Therefore, he's going to say, look, if you mismanage the business, therefore, I have the right to send you a letter and say, hey, you took the money for the wrong cause. I'm kicking you out and I'm taking over the business. If you're honest, if you're hardworking, you have nothing to worry about. But you have to be aware of it, that it's very common for the next circle of investors to ask and demand that, and to make sure that you are doing the work. Now, how do you address it? Well, here's the tip. Be active. Be proactive. With John, you can just call, or you meet John on the weekend for a beer. And you say, hey, John, here's what's happening with the restaurant we're opening. But with the investors, the next cycle, you need to really be on top of it. Always give them more information than what they need. Better send them more information than what they're asking for. They might not open the email, but they know that an email came from you with information. The minimal you need to do is send a quarterly report. Minimal. In the report, you need to have a few components, and that's a classic standard. They're expecting it because wealthy people, rich people, have standards that they're expecting you to do. You should have financial, not just a story. Oh, the market is doing very well. We're going to no. I want hardcore, simple numbers. How much did I invest? What's happening with my money? If you open a restaurant, I gave you $2.5 million. Where's the money going? How is the benefits? Tell 3 components of every report. 1 is general. Okay, educate me. I don't know anything about restaurants. You're opening a restaurant. Tell me about what, let's say it's New York City, because we're in New York City. What's happening in the market? Is the market good for restaurants? Is the market not good? Is people spending more money? People not spending? What's the challenges? So generally about restaurants in New York City. The next thing is about what's happening in your business. What are the problems and the good things that are happening? So if I'm sending you a quarterly report, and by the way, with AI today, it's very easy to write a beautiful letter, okay? The benefit, the good thing about my business this month, we got an amazing review from a magazine or from a newspaper. We have people booking the place, and we've been sold out on the weekend, right? The challenge is, don't hide the bad news, because if things go bad, they're like, why didn't you tell me before? Tell them, oh, I just lost my sous chef. I have a hard time finding people to work for me as a waiter. I'm very busy on the weekend, but I'm not doing very well on Monday and Tuesday and Wednesday. Share with your investor. Your investors are your partners. You hide information from them. When things don't go well, they're not going to be there for you. That's a critical point. I'm going to repeat it. If you don't take care of your investors, if you don't share with them the good and the bad about your business, when things go wrong, they will not come with you. They will not support you. Then there's a quarter you don't pay them. By the way, in businesses, there are always going to be times when you're being challenged. If you don't take care of investors when things are good, they're not going to take care of you when things are bad. So quarterly report, 1, general about the business. Then the next thing is what's happened specific in your business, in your startup. How many employees do you have right now? What's your challenges? What keeps you up at night? Say the true and the honest thing to your investors. And then the opportunities. What's going to happen next quarter? What should I expect as investors next quarters? Next quarter, we're opening for lunch in the restaurant. Next quarter, we're releasing the MVP, the minimal viable product of our app on our startup. That's so I can actually go and look at your report and say, oh, look, he promised and he delivered. Or he promised he didn't deliver, but he explained to me why he couldn't deliver next quarter, right? And the third thing is numbers. Numbers. It's all fluff. It's all marketing if you do not give me the numbers. If you send me a whole email with tell me how the market is and how I'm doing and how hard I'm working, if you don't give me the numbers, I could care less, because all you're doing is you're selling me marketing. I'm your partner. I want to know the facts. So quarterly report at least. If you have great news or really bad news and you feel like you need to address it, do it before the quarter report. Let's just say that you open a restaurant and the New York Times, huge impact, just reviewed, and you got 4 or 5 stars, 5 out of 5 at the New York Times. You must share that information. You must share that information with your investors. This is great news. Don't wait for the end of the quarter. Let's just say that you open a restaurant and a pipe burst and flooded your entire kitchen, and now you have to close down for a week. Send an email. Be proactive. Think about what will my investor want to know, even when it's bad news, not always good news. And I'll give you one example. In 2008, if any of you are old enough, there was a financial crisis, a huge, one of the largest financial crises. And I was in real estate, and I didn't have money. I lost a lot, and I didn't have money. And I called a bank I worked with, a lender that I work with, and I asked the CEO of the bank to talk to me. He knew me very well. It was a lender. It wasn't a regular bank. And I said to him, look, I want to tell you up front, this month, that was the end of the month, so I could have had plenty of time. This month, I'm not going to pay you the interest. And he was like, what do you mean? He said, look, we had a crisis. I don't have the money. I'm not going to have the money in 2 weeks. Now, that's not really an investor of mine because he was a lender. He was debt. But the fact that I proactively called him 2 weeks before the interests were due was mind-blowing to him because he's so used to people not paying the interest, and they send a letter and then another letter and then phone calls and eventually start a foreclosure action. He never, according to him, never had someone proactively call him and say, look, don't expect the interest this month. Now, it wasn't good news, really bad news, but he had so much flexibility, so much compassion. He was willing to work with me. He worked out the problem with me instead of fighting me because I was proactive, because I gave them bad news before he expected it. And that was amazing. The same with the investors. Good and bad, don't wait for that quarter, okay? So, to summarize the few minutes we spend on the next circle, I'm going back, friends and family. First immediate circle, flexible, cheaper, simple. Next one is wealthy individuals, private money. More complex, more legal work, more chance to be kicked out, more communication. Benefit of it, more money. Your friends will not be able to give you a lot of money. Wealthy individual will give you next level of money. You can raise $2.5, $3, $5, $10, $50 million by using investors, by using wealthy individuals. Now, there's nothing wealthy individual like more than sitting at their house in Miami Beach or in the Hamptons and say to the friend, oh, you see that Porsche that's parked outside? I bought it from a new investment I did. Oh, really? What did you do? I invested with this guy who opened a restaurant. Really? Can I meet the guy? So they are your biggest agent. They're your biggest ambassadors because they have a network of wealthy individuals. Your friends maybe, or your family might want to help you, but how many people, your mom, who put $100,000 with you, which is amazing, and you got to thank her for that. How many of her friends are that rich? Wealthy individuals have a lot of rich friends. They love to brag. They love to be proud because you are reflecting on them. If they invest with you and you did well for them, they love walking around and say, look, I'm smart. I invest in the right deals. So they will share with their friends. So you can raise millions of dollars in the ability to open it. By the way, just an example, if you know the history of Starbucks, Starbucks is this guy who didn't do anything. He just was passionate about Starbucks. He was passionate about espresso, about cappuccino, he traveled to Italy and fell in love with coffee. And he found this great idea. And he met someone who said to him, you got to meet in Seattle this really big attorney. This big attorney met with him. He pitched the idea. By the way, attorneys are already wealthy, especially if they're partners. But that person, and I'm not going to say his name, said, look, I want to meet you. I want you to come back to my office in a few days because I want to introduce you to my son. His guy's name was Gates Sr. He was Bill Gates' dad. He was the attorney that they came to pitch, but also do some legal work, and introduced him to this young guy named Bill Gates. And Bill Gates, very, very rich person, already in his 20s, was one of the first investors in Starbucks. So why is it a great lesson? When the founder, Schultz, founder of Starbucks, went to meet this attorney, he didn't make the connection. All he knew is that this very connected, successful, well-connected attorney in Seattle who can help him with legal structure, but can also help him with investing some money. He never knew that this attorney's son is Bill Gates. And that's how you want to create it. You want to take care of your investors. You want to be involved so you can increase it. Okay? So that's the two circles. Let's go back. Let's go and continue. Then third and the fourth circles and keep on growing it. Now, by the way, you might pause for a second and say to yourself, okay, why do I want to keep on hearing grow and grow? Because if you're happy with the investors you have right now, you can stop. You might open a coffee shop, an espresso bar, and you raised $1 million from friends and family, and you're very happy. You open the espresso bar in the morning, you have baristas and a person working for you, and you're making money, and you're happy. I'm not telling you today that actually you need to go to the next level, to the wealthy individuals. I'm talking today to someone who, first of all, needs to understand whether you stop on the friends and family level or you go all the way to the top. Okay, you need to understand the different circles because each one of them has benefits and challenges. But also, I'm talking to the person who's hungry, the top performers, the what we call, the Zenith Code from the book, people who wants to be more successful. And most of them are going to go through all four phases. Some of you get stopped in one level. I'm not saying it's a bad thing. I'm not saying you can stop at friends and family. You can have, I know very successful people who've been working with the same investors for 15 years. And they kept on making money, more and more and more money to those investors. And investors put $250,000 and then increase it to $500,000 and then said to them, you're doing so well for me, I'm going to leave the money with you. And let's say they double their money in a few years. Now they have $1 million of each person. You can get $100 million from wealthy individuals because you keep on, a lot of successful people, they're already wealthy, they're already successful, they're going to leave the money in. If you do well with them, they put $250,000, they test the water with you with $100,000 or a little more. But the moment you do well with them, they say, you know what, I don't need the money, I'm already successful, I'm going to leave the money in. So you doubled my money, I'm leaving it in. You double it again, I'm leaving it in. And that's how you grow. And that might be enough for you. You send quarterly report, you give them access, all is well, right? But again, I want you to understand the entire picture, and then you can go back and say, I want to stay with a small circle, I want to increase all the way. So let's talk about the next thing. The next thing is what we call public investors, okay? It's what's called family offices or even funds. What is family office? Let's just say, I'm going to pause and give you an understanding of what family office. Let's just say that you started a startup or in your 20s and did very, very well. And a few years later, Facebook came and bought your business. You developed some software or some ability, and Facebook came to you and said, here's $100 million. I want to buy you out. And you said yes, and you sold the company. And now you have $100 million or less. But let's just say $100 million in your account. Now, you're a tech person. You did very, very well. You are crazy rich. But many people will go to financial advisors and say, look, I just got $100 million. I never had so much money. What the hell do I do with so much money? In that case, you become a member of what's called a family office. The people who specialize in managing wealthy people's money. Managing wealthy families. So if your family is third generation oil and gas, they have hundreds of millions of dollars. The average person doesn't know how to manage it. By the way, you can see why a lot of people lose their money because they get huge check, whether they're winning the lottery or selling the company. They don't know how to manage it and they make mistakes. They don't know how to plan their taxes. They do the wrong thing. And then a few years later, they lose all the money. So successful and smart people go to offices, multifamily offices, family offices, and say, here's my money. Manage it for me. Tell me what's the best tax structure. Tell me how much money I should leave in the stocks, how much I leave in bonds, how much I should plan it, how much I should invest in things. And those people make a lot of money managing those wealthy people's money. That's called family office. So in a family office, whether it's on Madison Avenue or somewhere in Miami or somewhere in California or somewhere in Dubai, they get the advice of how to manage this money, and they meet you because some wealthy person that invests with you, and they say to you, look, we are managing 20 or 50 or 100 families, and each one of them put substantial money. We manage $1 billion or $500 million. Now we're looking for opportunities because their job, the family office, get paid to invest the client's money with someone. And now you have track record because you start with friends and family. 2 years later, you move to the next circle and you went to private money and wealthy individuals. They did well with you. A year, 2 years, now you've been in the business for 5 years, you have a track record. Those people, it's a different shift. Their job is to find opportunities, but they don't want to take a risk. Why don't they want to take a risk? They no longer have as much stake as your family in the business. They're managing other people's money. Now, if they did very, very well for those families, they're going to keep the contract. They're going to keep on managing the people. But if they didn't if they lost money, they're going to lose. And that wealthy, rich family is going to take their money to some other family office. So they're more about risk management than opportunity. That's critical. I want to pause for a second and talk about it. In the beginning, as an entrepreneur, as someone who invests with you, I want to take risk. I said, look, I know you want to open a restaurant, but I want to grow with you. I'm willing to risk $100,000 and invest with you. If you jump to investors, to public money, or to family office, the person who's managing the money is more concerned about the risk because they don't want to lose money to that very wealthy family that gave them $100 million to manage. So they generally invest in businesses that have a track record, that are larger, that are risk tolerant, that they can stay a while. So they go into manufacture. They're looking into real estate. They're looking at things that has a higher safety. They have lower risk. And they are all about legal. They're all about the contract. You're going to spend sometimes hundreds of thousands of dollars. Now you have it because you're already successful. Hundreds of thousands of dollars on legal fees to design the relationship with them. You're going to have a lot of attorneys protecting you, and there's a lot of attorneys protecting them. The good thing about it is that you can raise a lot of money. You can get to hundreds of millions of dollars raising money from private funds, private equity, family offices. The challenge is it's slow and it's big. Think about it. It's a machine that moves on. So if you need to open a restaurant tomorrow morning, you never go to those people because by the time you get to know them, by the time they do due diligence on you, by the time they talk to attorneys, it might take you 2 months, 3 months, 6 months, a year to get the check. But that check is going to be a check of $50 million, $100 million investing in you, $20 million, right? So we're jumping back and forth today about the good things and the bad thing. The good thing, big checks. So if you open a restaurant, going back to the original reason, now you have 3 locations. You want to open a chain through the country. Now you go to that level. You need big checks, big money. It's not about personal relationship. It's about the legal structure. They're going to look and they're going to make sure you cross the T's and dot the I's. They're going to look at every actions you take. Now, you might have a new challenge because you open a business. You're so used to doing whatever you want, work whatever. On that level, sometimes you feel like you are now working for them. And that's something you have to be mature enough and ready to take it on. So I don't want to spend too much time on it today, but when you have very big investors, sometimes the dynamic of relationships changes. And you find a sugar daddy. Yes, they give you a lot of money, but basically you work for them. And you have to see if that's something that fits for you. You might say, look, I can raise $100 million. I can raise $150 million. But they have so much involved in my business, I basically work for them. Do I really want that? And by the way, when you raise money for technology, it's going to happen. Series C, big investors, they're going to come to you, the very big funds, and they're going to say, here's what we need. We dictate. Here's the shares we're taking. Here's the problems. Again, big opportunities, big headaches. That's the next level. Don't want to spend too much on it. The last circle, and that's a really big one, and I want to spend only a minute or two on it just to understand it. The very last level of investors is what's called going public, is when you raise money from going public. IPOs, you registered your company with either the stock exchange, the London Stock Exchange, depends on the thing. You can raise different levels of that. And the benefit of it is that you can raise billions and billions of dollars. The challenge with it that now your company is controlled in most cases, except for technology, which I don't want to talk about today, but they have a way to do stocks that you still keep the control, like Facebook and Google, etc. But I'm not going to talk about it today. You sold your company basically to the public. And that's a whole different things. And I wish you all the best if that's the direction you want to go. But not a lot of you who are going to watch this video are going to actually get to a public company. If you get to a public company, that's a whole level. Again, benefit of it, you can raise billions and billions of money. You can take substantial amount of money. The challenge is that it's a whole different thing. You're working for your stock, for the shareholders. You have other elements of it, and that's a very, very large. And by the way, we had some guests who took the company public in the past on the podcast, and you can listen to the benefit of it on that. So that's the last thing, when investors are public investors, and that's going to cost you $1 million to do it. And when you do it, it's a very long commitment, and there's very little, again, the larger the check, the less flexibility. So going back to the beginning of the conversation, today we walk through 4 different levels: the friends and family, the original thing, the kind of like close thing is. The second thing is wealthy individual. The third one is family offices and funds. And the fourth one is private money, public money going public with it, right? Ask yourself, where do you want to be? You might not be there. You might be someone who's just thinking about the idea of where I want to open a business. But understanding the entire journey of equity, of investors is critical for you, because then you can operate. You can, from the beginning, start to think about, yes, I'm raising just money from my family. I'm raising $500,000, $500,000 from 10 people, $50,000 each. But my goal is to be a chain. My goal is to be huge. My goal is to be public. From the beginning, you see the entire journey. Or you can say, no, I'm really good with just 10 investors that become my friends. They're going to be good and bad for me. When things go bad, they're my partners. I can call them and tell them, look, things are really rough. I'm going to work really hard to turn things around. Or when we do very well, I'm going to be very generous. Here's a few tips I want to leave you with. First of all, neither levels is good or bad. It depends what the game you want to play, right? So it's all a game, right? If you want an espresso company, you just have to raise a few friends, espresso coffee shop. You just have to raise a little bit of money on it. You want to be Starbucks or whatever the big chain is, you have to raise a lot of money. That's a different path, right? So nothing is good or bad. They have benefits, and they have good, and they have bad. Second thing is, take care of your investors, whether public, funds, friends and family, or someone in between. Take care of them. They are your biggest ambassadors. People fail all the time. I meet numerous people. I failed myself many times, okay? The reason why people reinvest with you, the people are willing to tolerate your failures, is because they knew how you behaved when things were rough. It's very easy to be generous and to be great when things are doing well, when everybody's making money. But now, no business goes through only good times, okay? Some businesses go through bad times. And investors are your partners. Your partners will know how you behave when things were bad, not when things were good. So therefore, keep on waking up every morning and ask yourself, how am I going to take care of my investors? That's critical. You take care of them, they'll take care of you, okay? And the last thing is, the bigger you are, the less flexibility. The more legal work, the more tip, the more it is. So that's it. That's Unmask Academy for today. I walked you through a very long conversation, not so long, but 40 minutes of all the 4 levels of equity, of investors. And now you can take actions. Now it's about you going back and say, what's the level I want? What's the next thing to do? Friends and family, what do I need to do? Go to the next level. How can I start working quarterly report? Take actions now. There's no one way to do it. There's no right or wrong way. Bloomberg, huge company. Michael Bloomberg from the beginning said, I never want to be public. I never want to, I'm from the beginning, I'm going to build it slow and steady. He was brilliant, and he got to be a huge company. He's himself worth over $25 billion, and he never brought investors to the thing. But that's one out of hundreds of thousands of companies. 99% of companies have investors. 99% of companies raise money ongoingly, right? So unless you think you're Bloomberg or you think that you have this ability, whether you like it or not, you will have to bring investors investors in, and that's what's so important. So I hope and I believe you got some value out of it. Of course, you can always ask us, send us a message, ask questions so I can address it in one of the playbooks, and enjoy the rest of the time, and thanks for being with us.